but we haven't quite got to the stage where the market is rewarding certain companies for a better ESG score than another company.
There are plenty of ESG elements that are about risk mitigation and risk management. But this, alongside positive actions taken by companies in respect of things that enhance their social license, will actually create a greater opportunity set for companies that excel in these areas. The best actors here will be prioritised by governments for new licenses, and companies selling assets, perhaps smaller companies, are increasingly prioritising the ESG performance of the next owner as much as they are the price that they might receive in a sales process.
I feel that this is going to become more than a box tick. It's going to become something that is going to be required in order for companies to access financing and even potentially get insurance.
Investors will move towards ESG, more ESG compliant companies, and I think that will open avenues for those companies to raise capital more readily. I think you're already seeing this with investments from people like GM and Ford and so on, who are looking very much to have ESG compliant supply chains.
Look, as long as we're looking at your ESG credentials and they are improving over time, that's going to get us comfort in investing in this particular company. Once we have a credible score or rating, not so much a score, but a rating on the ESG, and it's front and foremost, and the broader investors, not just the mining people who know mining that we pitch to and we talk to, once they really understand what's happening as far as ESG is concerned across the mining industry, and you can compare apples with apples, I think we're going to get a big re-rating in the sector as a whole.
The long-term sustainability of a company clearly impacts its value, and a company's approach to incorporating the many dimensions of ESG into its business will be that key driver of whether the business has a long-term future and a long-term value.
Beyond cost, access to capital is becoming more and more a function of ESG performance out of pure risks management, but also because lenders have their own sustainability agenda, which applies in the first place to their lending books.
We really need to move forward, because I feel that we're still really marketing to a small pool of investors that are willing to understand the mining sector from an ESG perspective. And then there's this big pool who just see mining as a dirty industry, and they don't really want to even consider open the door or listen to these companies.
And I think also you could end up, and you've seen bits of this already, for example in nickel, you could end up with a bifurcation of pricing for certain commodities depending on the source of those commodities and the location of the source, and also the ESG metrics around that source.
We as an industry need to find a way of demonstrating the often exceptional work that mining companies do on the S factor. Education, healthcare, training, infrastructure, etc., in communities that are often remote, under development, and devoid of other formal employment opportunities. We need to find a way of quantifying this positive side of the ledger and make this argument around a balance about mitigating negatives but growing positives. And I think when this occurs, we will enable greater differentiation in the cost of capital, both on the equity and the debt side for these companies.